the sector performance with the FAME stocks right there. The only thing that was positive was consumer discretionary. And as Edward mentioned in the weekly research report, you can see the top 4 stocks here: Amazon, Tesla, Home Depot, Nike. Tesla, Home Depot, and Nike were all positive on the week, and Amazon was only down 0.4%. But as we've also talked about in the past, the consumer discretionary sector is so top heavy, with these 4 stocks making up like 50% of the ETF that you want to look at, the equal weighted one, which is the ticker symbol RCD. And RCD, equal weighted consumer discretionary, was down 1.3%, a little bit less than the overall market. So if there was any safe haven last week, sector-wise, style-wise, it was consumer discretionary, but limited to basically the top 4 names in the ETF. So here we are this week. Last week we fell pretty nicely, almost 2% on the week, 1.69% on the S&P 500. So I think that's the biggest weekly decline that we had in over a month now. Some streaks came to an end. We'll go over those, of course. And Jim Cramer says it's not over. I need you to expect some brutal days ahead. Same headlines we see all the time, especially when you have such a long winning streak like we do, 7 months in a row where the S&P 500 has produced positive returns. The slightest hiccup and the drum beats just get louder. Again, the chart here showing we have had a 5% correction this year. The only thing is we didn't have it on a closing basis. It was intraday, and then we had a really sharp spike up intraday. So still without a 5% correction. Monday is the best day of the week going back a year, folks. So maybe today this 5-day losing streak ends. Maybe not. We'll find out. Study inside the weekly research report as well. 5-day losing streaks. The 1-day forward return is actually usually red, but the percent higher, meaning the number of times the market is higher, on the 6th day is 62%. The problem is, you have a big loss here going back to 2020, right? That's February. Things got really bad, down 4.4%. Here also in 2019, next day was down 2.98%. I imagine that was a pretty good headline. That is August. Remember in 2019 in August, we had the yield curve invert. So indeed, big down day that particular day. But most of the time, there's a lot more white on the screen than there is red on that 6th day. 2 days later, still 62.5% win percentage, but you're starting to get some, positive returns. Positive return on the 3rd day, 4th day, 5th day. Almost all 62% on the 4th day, 68% positive rate, and 20-day return, 68% of the time. The market's up, slight, positive return. So we'll see what happens going forward here, folks. So we are up 7 months in a row. This is a study I wanted to look at here. Again, we're up 7 months in a row because this was the 6-month winning streak. For any of you that were confused when you saw this study here, we had a 6-month winning streak, and then indeed 1 month later, 7-month winning streak. Right, so that's August out the door. Here we are in September, 2 months later. Are we going to have an 8-month winning streak? Market is positive 63% of the time on that 8th month, if you will. Return, 1.28%. It's not too bad. Now, a study just below this is, what about the maximum drawdown? We've had such a strong winning streak. Here we are, we got a hiccup in the market again, down just about 2% from the all-time highs. But after a 7-month winning streak, you know, what might we expect in the way of a maximum drawdown over the following 4 months, since we're here in September? So September, October, November, December, 4-month time period after a 7-month win streak, and that's happened. 7-month win streaks, right? The max 4-month drawdown average is 2.13%. The median is 1.86%. But you got this 6%er here, right? So what are the odds that we'll be in for an above average maximum drawdown, meaning a greater than the average drawdown? Well, I would go back and look at, 1996. What did the chart look like then? What was the participation like then? One of the other things about 1996, and we should probably go check it out, right? Let's do that. I was actually looking at the Twitter chart. We talked about this, and we'll kind of segue back to the 1996 chart for the S&P 500. But briefly here, this is the Twitter, and there's the 200-day moving average. We talked about this chart last week. We're not buyers until it hits and breaches that 200-day moving average. And this morning it received a coverage initiated by Goldman Sachs, and they initiated coverage with a sell rating on it. Let's see here. Oh, crap, geez, it's not there now. But they did, yeah. And that's why it's under pressure. I mean, you got a strong market futures presentation right now, and yet Twitter's under some pretty good pressure. I think that's largely predicated on both Goldman Sachs initiated coverage with the sell rating, as well as the fact that it is so close to the 200-day moving average. It just needs catalyst to get there. And I think today's headline gets you there, and breaks below. I think it comes in at about 61.10 now or so. Let's see, 61.20. Last week it was 61.05, but every week it will advance higher when in an uptrend. So 61.20, and it looks like it is going to open below that level. I'd like to see washout. I'd like to see some volume here. So I wouldn't go in right away. Let price action through the order flow hour kind of take care of itself. Before you start, that first position, if inclined to take one. All right, so S&P 500, we're going to go back and look at the 1996. And the reason why I want to do this is because that study that we just looked at with respect to a 7-month winning streak and 4-month max drawdown that takes us into the end of the year, that's just one data point, right? 7-month win streak is just one data point. What other data points are out there that would might help us with deciphering whether or not we're going to get a better than average max drawdown over the next 4 months? Are we going to get a big one like this, relatively speaking big? Or is it going to be the average and somewhere in between? So let's see. Let's change that. Let's go to the end of the year. And this is what I'm doing all the time, by the way, with data points, to see if this is going to be an outlier or whatnot. I'm always going back to individual. If something jumps out on me in one of these studies, I'll go back and look at the technical formations and whatever to see if there's an anomaly that could create the conditions for a bigger move, or a move beyond what the study is indicating. So What do we know about 2021? Well, we know that we haven't had a 5% drawdown on a closing basis. Guess what? We did have more than a 5% drawdown here in 1996. That's the 200-day moving average, by the way, which is another data point. We have not touched or closed below the 200-day moving average here in 2021, but we did in 1996. So what do we know about the fact that we haven't had a 5% drawdown here in 2021? Maybe the 1996 is an outlier for a reason. It had a couple different corrections. It had, well, a couple larger pullbacks. This one here from, let's call it, well, that's not even the peak, 675, 678, 679, all the way down to 616 intraday here. That's a 10% correction, right? So it seems like, and it did it again here at the end of the year, a pretty big correction here for the time period. Remember, this is 90, we're below 1,000 on the S&P 500. So this particular year doesn't really align with the conditions that we have in 2021, and maybe that is why we did have a bigger drawdown. Conditions really aren't the same. If we look at some more moving averages, which are good, they're both sloping higher here. We've spent a couple days below the 50-day moving average, couple days below the 50-day moving average, a lot of time here below the 50-day moving average. We have not, in 2021, compared to 1996, which is in the study, we have not spent 2 consecutive days below the 50-day moving average in 2021. Which year is stronger? If only based on these 2 metrics, or moving averages, support levels, we'd have to go with 2021. I'm going to put up the 100-day just so we can all see. And they're all nicely upsloping. Don't get me wrong. This is what you want to see in a bull market. All the major moving averages sloping higher. Take your screenshot if you must. Now let's look at today. All right. It's pretty good slopes. Yeah. The 200-day leaves a little bit to be desired, but again, we crossed below it on 3 separate occasions here in the month of July going into early August 1996. Now let's look at the 1-year chart today. Look at that. Again, we have not spent 2 consecutive days below the 50-day moving average on a closing basis here in 2021. Look at the slope of the 200-day moving average up here. That is rapid ascension. 100-day moving average, rapid ascension, 50-day moving average. It's been support, beautiful support. Here fell below, but quickly rose above. This is 2020. That was just before the election. That was the last time we had consecutive days below the 50-day moving average. October, going into November's election week in 2020. In 2021, we have not. It's been beautiful support the whole way. So the question is, this is the kind of work you do when you see these outliers in studies. 4-month drawdown after a 7-month win streak. Look at the differences in the technicals. We could look at more, certainly. We could look at breadth, could do that going back to 1996, but these key moving averages, in my opinion, tell you a lot. They don't exonerate. Don't get me wrong. They don't exonerate seeing a 6% pullback. They simply amplify the need for a catalyst. It's not going to happen just because. That's what the technicals tell us. We're not going to get something on the order of magnitude of 5% or greater correction just because, right? Just because the market is overdue. It doesn't work that way. There's no schedule for the market. It doesn't clock in and out like you and I do as traders. Right? Some of us clock in at 4 a.m. Some of us clock in at 8 a.m. And, most of us clock out at 4. Others of us are trading the futures or after hours, clocking out at post 6 p.m. Eastern Standard Time. But the market doesn't have a clock. There's no overdue, underdue, overly correct. These are just hyperbolic, nonsensical words used mostly by people that aren't prepared. They haven't set the expectation, of anticipating a correction on a quarterly basis. Again, every year going back to the average, correction going back to 1980 is 13+% a year. That's the average going back to, naturally there were big years where the market fell, 20, 30+%. 2008, 1987, the dot-com years. But then there were also years where we didn't fall more than 3%, like 2017. So the average year going back to 1980 has a 13+% correction. It should be baked into your quarterly expectations for the 4 quarters of the year. The people who say we're overdue, they're just not prepared. All right. So, we're down 2% from the all-time high right now. We have futures nicely bid this morning, slightly off their high. We have the VIX retreating nicely this morning. We got several positions on the board that we initiated over the last 2 weeks. And we'll see, when we'll be able to take those profits. For this week, the calendar of the economic rollouts, releases, somewhat light. There's no data of consequence this morning. Tomorrow, things kind of get more serious. Friday, we had the release of the producer price index, which was hotter than anticipated on a year-over-year basis, but the month-over-month suggests that we are hitting a plateau. We'll need to see it roll over in the next month or two to validate that sentiment, though. So tomorrow we'll get the small business index, and of course, after one inflation data point comes the next, which is consumer price index tomorrow at 8:30. It might be one of the reasons why, even though futures are nicely bid here today, bond yields are not. So they're buying bonds, bond prices go higher, the yields go lower. I think the bond market is just they want to see what CPI is. So that's tomorrow. Then we start getting into the manufacturing data once again, the Empire State Index on Wednesday, industrial production, but none of these are likely going to prove market moving. Thursday, a little more relevant, you have Philly Fed manufacturing, of course, jobless claims, and the highly anticipated, based on last month's disappointing retail sales, when you get the August monthly retail sales. And they should come in pretty good. Based on the high frequency data that we've been headlining here in the trading room over the course of August, Redbook Johnson retail sales comes out every week, displays year-over-year retail sales. And the month of August, Pretty darn good here, folks. The median level for 1, 2, 3, 4 weeks looks a lot better than July. This one's not there, but 1, 2, 3, 4 weeks. August, 1, 2, 3, 4 weeks. And this is year over year. So the high frequency data does suggest that, we saw somewhat of a rebound. That's just one data point with respect to gauging high frequency data for forecasting the monthly Census Bureau retail sales report. Again, due out on Thursday. A couple weeks ago in our weekly research report, we also highlighted, nope, that's wrong. Okay. Chicago Fed Advanced Retail Trade Summary, which is another high frequency retail trade index, if you will. And based on their tracking for the month of August, retail and food services sales, excluding motor vehicles and parts, are projected to increase 1.3% from July on a seasonally adjusted basis, and to increase 1.1% when adjusted for inflation, i.e. real retail sales. Could both of these high frequency data points be wrong? Absolutely. Yeah, the sample size is not, they're not using the same sample size as the Census Bureau is using. But it should be in the ballpark. It should be in the ballpark. Time will tell, of course. And on Friday, we have the first, or the preliminary reading of the August consumer sentiment. I'm just realizing my wife's not back yet. Oh, you are? Okay. I got nervous there for a second. All right. Highest we're not in earnings season. And, in the way of what could the catalyst be for the market to go higher? As I mentioned in the weekly research report, one of the catalysts is just better valuations. The market goes down. The dip buyers, generally, their appetite gets that much more ferocious, especially when profit margins are, basically at a multi-decade record level. Profit margins are the best that they've been since the 1960s, essentially. Never let a good sale go to waste. Now, I'll admit, one of the things that does concern me with respect to the current market landscape, and as it pertains to have the probabilities improved for a 5% correction to finally arise here in 2021. As I've said before, there are at least two ways in which a correction could take place: conditions or a catalyst. At this point 1 year ago, the big 5 stocks in the S&P 500 had reached max outperformance of greater than 60 percentage points versus the other 495 stocks in the index. This was last year's. The blue line here, this is this year, right? So this year you don't have this enormous spread between the big 5 stocks, your Facebook, your Apple, your Amazon, your Microsoft, your Google, and the other 495 stocks in the index. It's just not there. So you don't have this overvaluation in one area of the market versus other areas of the market. So that's a condition that proved favorable for the S&P 500 to express this kind of streak without a 5% correction since last year. So what do you have to do? What do you have to do to get that 5% correction? Well, essentially, you got to hit the big cap stocks, and maybe not just one, right? Because Amazon went on its own wild ride after its earnings release, dropped all the way down to the 3,100 range from 3,500s, 3,600s. It's since bounced back to 3,500 plus. rather quickly. In what, 3 weeks, maybe? But the judge's announcement or the judge's ruling last week on Apple, right? That's another big cap, big five stock. Forced Apple, see some pretty good pressure on Friday, down 3+%. It's down a good 5+% from its all-time highs now. And the ruling didn't just affect Apple. It also affected or impacted Google shares, which dropped almost 2% on the day last Friday. Now, both are bid up here this morning, but again, we're talking about there's at least two ways in which a market can correct. Either conditions have to be right. They weren't right based on this chart, the top 5 stocks versus the other 495. But if you get a catalyst, it can create the conditions. And so the question at this point is, when you had two of the biggest stocks in the S&P 500 under pressure because of this ruling, this court ruling, does that create the conditions? I would say it does improve the probability of a 5% correction happening. It just does, due to market structure. These are the most heavily weighted stocks in the S&P 500. If you take a few of them down, it's going to be hard to keep the index up, especially when you have a lot of overhanging sentiment with respect to a slowing economic backdrop. Some people say slowing, I say normalizing, right? We were not going to stay at above average GDP growth rates quarter after quarter after quarter in perpetuity. We were going to normalize. I think of it as just normalization back to a 2.5, between a 2.5 and 4%, annualized GDP growth rate, which there's nothing wrong with, folks. That's what we ran at for around 2.5% GDP for a good decade post the great financial crisis on average. Again, kind of putting all these factors together, though, if these big 5 stocks can't hold up and you have this weakened investor sentiment due to a normalizing economic backdrop, the conditions do improve to manifest into a 5% or greater than 5% correction. In no way, shape, or form is that my forecast. And quite frankly, I don't care. If the market wants to correct 5% or greater, let it correct 5% or greater. Why? Because we're not going into a recession. Right? What are the odds that we're going to have a recession in back-to-back years? Right? Meaning that, A, we've had to have a recession, but then an expansion cycle, and then dip right into another recession. That hasn't happened in the modern era. You would have to go back to the pre-World War II, where the double dip recession verbiage or adage comes into play. Double dip recessions are very, very few and far between. What are the odds that the market is going to go into a what are the odds we're going to have both back-to-back years with an economic recession and back-to-back years of bear markets? It's kind of why I think it's a little comical when I hear and see all these bearish headlines and commentary looking for 10 to 20% corrections. I'm like, are we just not studying history, or are we leaning solely on the fact that we haven't had a greater correction since October of last year? And just, the overdue nonsense. September, Again, not the greatest month. We have these seasonal headwinds. It's another condition. It's another, headwind the market is facing at this time. What you do want to see is a strong bounce back here this week. It is monthly options expiration week. Talked about that, which has not been good for the S&P 500 over the last 13 monthly options expiration weeks, only up 10 times out of those 13 monthly. But good news, September's options expiration week is up 59% of the time, going back to 1982. That's actually the third best monthly options expiration performance for a month in the year. The others, I want to say, are March and I think December, But most monthly options expiration weeks for any given month have a negative performance, meaning the S&P 500 is up less than 50% of the time. So we're in a good month. If we are looking for a bounce back here, or at least the end to the 5-day losing streak, Mondays have delivered the best return for the S&P 500 over the last year. We have the study up here from Steve Depp that tells us also 5-day losing streaks, the next day, the 1-day return. The market is higher 62.5% of the time. The median, which basically, takes out that 2020 anomaly where the market was down 4%, almost 4.5% in one day. So the next day, positive. Here it is again. S&P 500 average percent change by day of the week over the last 12 months, Monday. So there are some signs that indeed, we should break that 5-day losing streak, but whether or not the whole week we're going to see the market higher remains to be seen. Game plan. Let's see what else. All right, so are we washed? That's what I like to look at also, as you guys know. Breadth indicators, when they're trending positively, when we have bullish breadth, there's not much we can do. Price is going higher. Do you want to chase price higher? Most people don't. Most people are smart and looking to buy on the dip. Especially those investors and traders who are resourced, do their own due diligence, have financial market service subscriptions where they have developed these reliable resources that enable them to define, is the market washed out? Has it reached a trough level? Is it fast approaching that trough level? Can I start putting on positions? That's the best use of breadth indicators because they're actionable. Again, when breadth is trending bullishly, the market's moving higher, most people, it renders them, inactive. But when the market's pulling back and breadth indicators are trending bearishly, that is more actionable. So this particular one, we've had a 5-day losing streak. Most stocks in the S&P 500 are trading at their 5-day lows. That's what this chart shows us here. The percentage of S&P 500 stocks trading at 5-day lows is almost 53%, right? More stocks are trading at their 5-day lows than aren't. This is a 2 standard deviation threshold line. And you can see, several times we've gotten there and above, just about, which is where we are right now. So this 2 standard deviation level that comes in at about 58% gives us a reasonable approach to capital allocation. Usually when we get to this level here, we get a bit, one last push into oversold, washed out levels where you should be a buyer. Again, why should you be a buyer? Because maybe it can get even worse, right? Well, that's where, again, you refer to your buy the dip indicators. Is the yield curve inverted? No. And you're getting washout levels? Buy the dip. Are credit spreads blowing out? Nope. And you're getting washout levels? Buy the dip. Are earnings growing? Yes. And you're getting washout levels? Buy the dip. Is the economy in a recession? No. And you're getting washout levels? Buy the dip. So again, we don't always cross over. We don't always cross over. This is why you shouldn't be trying to time the washout level any more than you're trying to time the top. You should simply be buying at better valuations like we had last week, in accordance with your game plan. Leave yourself room in case we do wash out to buy at even better prices. Based on this breadth indicator right here, we should expect washout levels to present themselves in the very near future. Maybe it was Friday based on what futures look like here this morning, but we don't know that this is going to hold up, right? We don't know that these futures are going to hold. We've seen good futures turn into negative market performance on the day when the market opens. That's why you shouldn't be trying to time it. No, I'll wait till Monday. We were allocating on Friday. And if the market does roll over here intraday, we'll be looking to allocate that much more. It's not about timing the market. It's about time in the market. Always buy corrections. Your ABCs of investing. Always buy corrections. ABCs. Another breadth reading that is signaling, because there's not just one, right? There's hundreds of different breadth metrics to look at, or breadth indicators. This one, the S&P 500 stocks at their 10-day high minus their 10-day low. And this one says that indeed, Friday may have been that ultimate washout. This one says, we could kick over, because most of the time we do kick over the line. This one says most of the time that's about it. And we did get just below this 2 standard deviation level of 188, negative 188. We were at 192 as of Friday's close. Again, this is this percent S&P 500 stocks at 10-day highs minus 10-day lows. So we could certainly see more selling pressure as we have in the past, but not a whole heck of a lot. And again, we quickly get snatched up, very quickly get bought up. That's why, these look like just, needle points here. It's not like we stay down at these levels for days, folks. It's almost instantaneous. In this upwardly trending bull market, with earnings rapidly rising and constant, positive earnings breadth revisions, this market gets bought on every single dip. Tons of liquidity out there. Credit spreads are extremely tight. These are the conditions that you should be when the market gives you the opportunity to be buying a dip. Don't worry about getting the best price, the perfect entry. Don't make the perfect entry the enemy of a good entry point. Why ripple and roar? Why ripple and roar? And I wrote about it in here. You'll notice that before every major deterioration in this breadth indicator is typically preceded by a ripple or smaller decline in the breadth indicator. See here, smaller declines, then a rip. Smaller declines, then a rip. Smaller decline, although pretty big in and of itself, then a rip. Smaller decline, to the downside, to the downside. You usually get this ripple here before you get a roar, where you cross over that 2 standard deviation level. 2 standard deviations. We've talked about that before, right? This market in 2021, S&P 500 has that outsized move in a single day, a 2 standard deviation move in a single day. It takes basically 2 days to recoup everything that it's lost, which is the fastest recovery time since 2014, which was the last double-digit year that we had in 3 consecutive years. We were up 2012 double digits, 2013 double digits, 2014 double digits. We were up double digits in 2019, 2020. So far, we're up double digits here in 2021. Anybody have any questions? Apple Day. Yes, Apple's event day is tomorrow. Should be interesting. They're probably not going to make any mention, and it's official, by the way, with respect to Epic in the Apple versus Epic litigation. Epic has formally filed an appeal. Remember, Apple, the adjudication was favorable for Apple. Apple won on 9 of the 10 counts it was accused of. As I said on Friday, the fact that Epic was threatening to appeal on Friday after the verdict signaled that they had lost. They hadn't, they won on, that last account, which was a meaningful count against Apple. But there's a big lag time in between that, the judge's decision or verdict on, what Apple will have to do going forward. There's a lag time between what the judge outlined and when Apple actually has to implement it. Here we go. Yep, and there we're below 61 on Twitter now, folks. Twitter initiated with sell rating at Goldman Sachs. Sell rating announces price target of $60 a share. For those of you just joining us, we looked at last week the 200-day moving average. It is officially below the 200-day moving average here in the pre-market. I'm looking for a washout level, maybe in the 60-30s. I think it gets bought up nicely. This is kind of typical of Goldman Sachs. I mean, Goldman Sachs has been one of the biggest bears on Apple for years. For years. Sometimes they just get it wrong. They just get it wrong. Having said that, Twitter's in a downtrend. I mean, this is the lowest level that we've seen in several months. This is the first time it'll break below, and it has broken below the 200-day moving average in the past, but it quickly got bought up last time. So we'll see what happens with this break below the 200-day moving average going forward.